made a very, very successful transition from mortgage broking and financial planning. So you've got both hats, which is mortgage broker, people buying property, people love property, people asking about property, right? And then you're a financial planner, where I guess the principles of financial planning are to spread your risk and stuff. So you got these two quite different hats. So I thought today we'll get your take, having both hats, and you managing these situations very delicately, or from day to day in your life as a mortgage broker and financial planner. Shares versus property, right? Which one wins? So, like, how do you manage that question for people coming to you asking for financial advice? Like, how do you approach that question?
If it's all right, I think a good place to start is that, in Australia, I would say that we're quite well regulated, all right? And one of the things that ASIC is very strong on is that financial planners don't go over the line in terms of how they talk about property investment, right? So we're allowed to talk about it as a general category, all right? But when we start getting into the specifics of it, then we need to partner with a good property investment professional, which are usually real estate qualified and insured, and hopefully follow similar processes to what we do around doing good, diligent research about what we do. All right.
Yeah, yep. And when we're talking about shares, what are we talking about?
So it could be a whole range of things. So we could be talking about direct shares. We could be talking about what's called managed funds, which is like a pooled investment where you might put in 10 grand and you've got a small portion of, say, 200 different companies or 100 different companies. Could be talking index funds or ETFs as well, which are like managed funds, but they're low cost, probably what they call passive or computer managed type funds. All right. So, but there's thousands of different options in there, so it's very hard to categorize them simply.
Okay.
All right. So, but coming back to your question, so couple walks in and says, Hamish, shares or property? I guess the first thing I try and do with the couple is get a bit of an understanding of what their history's been. So, have they got family that's invested in one category over the other? Have they heard any success stories or horror stories from people about one category or the other? And because the reality is, even though it's not a reason to pick one, you do have to be a little bit careful that if somebody's had a great journey with property, or they've seen their family buy property, or they've got their own home and that's gone up in value, then they're more prepared to go on that journey if something doesn't quite go right. All right. And I think that is an important thing to recognise, is that the more comfortable and knowledgeable we are about an investment class, then the more committed we're going to be to sticking to the path, whatever happens. All right. So their background and journey, first sort of call it step or question. All right. So the second step or question that I would typically investigate is what we would call their risk profile, which is just their appetite for taking a bit of risk. Are they quite conservative people in their decisions and how they do things? Are they quite, comfortable taking risk? And so, for example, if a couple came in and one of them was a self-employed person, I would, in the back of my brain, go, okay, there's a good chance this person is probably a little bit more comfortable with risk, because, as you and I would agree, you don't really get into business unless you're comfortable with a little bit of risk. All right. Mm-hmm. So we've understood their background and what sort of biases or stories they've come to the table with. We've had a bit of a think about their risk profile, and because as a financial advisor, one of the things that we do have to be aware of is when you're going to borrow money to invest, then you need to be comfortable taking a level of risk. All right. So whether that's property or shares, same sort of thing. All right.
Okay, but let's just say someone's not borrowing any money and they're going to put, if someone is risk tolerant, someone who is open to risk, yep. What does that mean on the shares versus property spectrum debate? Or,
So if I put on my financial planning hat, all right, so a financial planner would say property is a growth asset, all right, so you need to be comfortable with a little bit of risk there, all right, yes. Especially if it's your first time. Whereas you can sort of design a shares portfolio to be more conservative, where it's got some bonds and fixed interest and credit type things, which would be by definition, and this is not a definition made by me, it's sort of by the industries, right, would have a lower level of risk. All right, so. And if I can draw quickly for, for people that are on YouTube or something, it's this volatility that you want to sort of try and work out, that how comfortable are you going on that roller coaster ride? And while property has a different thing, it generally has a call it a bit of a boost, and then it has a flat sort of line for a while it waits for the economy to catch up, and then it has a kick along again. So we sort of call it the step graph, as opposed to, you might call it the snake, which is the shares type thing. So does that answer that question?
Yeah, it does. I guess for the average Aussie, when you're coming up with the shares versus property, property has the advantage where, doesn't it? It has an inherent advantage because some people might already have one. People drive past them. People see, the papers where things go up and whatever. People have this, certainly in Australia, this innate feeling, that it might be safer, or they just understand it a bit more. So how do you educate people on the shares to bring people up to speed? Because sometimes you look at share graphs and they're very confusing. The pages that have all the stock quotes can be confusing. How do you demystify all of that to make people feel comfortable?
So I think what's really important is no matter what, is if you're going to put somebody into an investment, there has to be the right level of education. All right. And what you're touching on is that bias, that inherent bias that people come to the table with. We're a nation that loves property. We understand property a lot more. So that bias is different. Whereas people tend to have more of almost a nervousness about shares and stocks, because all they know is they see the 6 o'clock news with stock market has gone up by 3% or stock market's gone down by 2%, and they don't really understand why it would go up and down like that. But it's interesting, I had a couple a year ago who actually came to me and said, Hamish, we just want to do shares, we don't want to do property. All right. And I went, oh, okay. And interesting, it had come from a mortgage broker that had referred the couple in. And the reason why was because they saw property as being something that was risky because of tenants. All right. So they didn't understand the process of how do you manage your expectations around tenants. So we spent some time talking about that, and all of a sudden they went, oh, okay, so wait a second, by the time you take out landlord's insurance and you've got a good property manager and you buy something that's not too old, so you're not going to have too many repairs, you're actually minimizing or you're reducing that risk level that you're taking. And so the education started to help them on that journey. All right. Whereas I do find myself probably having that education conversation more with shares and managed funds than I do with property because of that. But the problem is that if you don't dig in and be deliberate around property with the clients, then what happens is sometimes they can find it's too easy. They can jump in, they can go, oh, water's warm, it's great, buy their first property, and then they get the first tenant and it's the tenant from hell. All right. So, and all of a sudden, they're backtracking. Oh, what have we done? All of these things, or they didn't get the rent they were expected, or something goes wrong. And if you haven't educated them, they don't get it. And so the education is really important. And bias isn't bad. So if somebody comes to the table saying, I'm more comfortable with property, that can be a bias that's good, because if you work with it properly, then you can use it as a support, all right? And it's a good thing, all right? It's when the bias is not healthy, or it's being formed in the wrong ways, that you've really got to ask the right questions to slow the person down and go, no, wait a sec. What you're talking about here is not healthy for us to keep going unless we talk about this a bit further.
Yep, got it. Now, so you've talked about, in terms of shares versus property, you've talked about the client's history, what they've done in the past. You've talked about their risk appetite, and now you've talked about education, right? So, but the tricky area, and I'll throw this at you, how do you even begin to answer the question, well, which one performs better over time? Like, ultimately, what we're all trying to do is invest and be successful with our investments. How do you answer the question, which one performs better? I mean, it's a very broad question, but there you go, the floor's yours. Which one performs better?
Yeah. Well, as well as I do, that one of the things that all research houses can do is they can manipulate data which way they want. All right, so they can make something look good, look bad. So it was interesting, and unfortunately they stopped this. But one of the first things I will talk about is there was a shares company that for a long time did these 20-year research papers on property versus shares in Australia. And unfortunately, it stopped about, I think, just before COVID, so about 3 years ago. But at the last report time, over 20 years, they basically talked about shares and property as a generic class across Australia behaving within 0.2% of each other.
Mm.
All right. So, and I'm not going to get these numbers right, but let's say it said property performed at 8.65% and shares performed at 8.45%. Right. So it really was that close. All right. So, but the trick in the data is that we're talking about aggregate property across Australia. All right. And we're talking about the whole stock market. Now you start saying, well, what if I want to buy a property in Melbourne or Perth or Brisbane? Well, you can't use that number for an aggregate across the whole country. You've got to dig into that area and what's going on there and that sort of thing. And one of the inherent problems with, call it the two asset classes, is that I can almost mimic the aggregate growth for the stock market quite easily because of the way the investments have been designed. But it's next to impossible to do the same thing with property unless somebody gets to the point where they've got 7 or 8 or 9 properties in different locations in Australia, of different types of property as well. All right. And so that becomes where the data becomes very difficult to manage. But if I start off with that report where it talks about, inherently the two asset classes behave in a very similar fashion. So then what I do is I talk about, the biggest separator when it comes to shares and managed funds versus property is how we buy them. So in other words, it's loans, debt. All right. So, and that most people, I think the last figure I saw was 75% of people buy a property with a loan. All right. So, and so when we take that into consideration and when you start to work out how using debt changes the outcome that you achieve, right? It just makes the numbers substantially different. And one of the things
just to paraphrase, just so people understand that, like I might have $100,000 worth of cash, and that might allow me to buy 100,000 worth of shares in BHP. But if I use that 100,000 as a deposit on a property, I might be able to buy a property worth 500,000 or 600,000. So I've got an asset base of 600 versus 100. I can leverage into property, and if both assets are returning 5%, one's 5% on 100 versus 5% on 500 or 600, of course we've got a loan we've got to pay off, and that all goes into the risk appetite, blah blah blah. Is that kind of where you're heading with that?
Absolutely.
Yeah.
And whilst you can do something similar with shares, right? So it's harder, and it's harder to get your head around as well. All right. So whereas property is just a natural, you could almost ask at the pub, who thinks you can buy a property without a loan? And you'd find at least half of the people would go, no, you can't do it without a loan. Right. Well, of course you can, but you've got to have a lot of money to do it. All right. So you get these biases that pop in that talk about, how we do this. So that top line, do they perform differently? Then talking about, what diversification looks like, and then borrowing. That's sort of how I try and answer that question. So again, it's more of almost an education piece rather than just a statement that says one does better than the other.
Yeah. All right. Look, so we've gone through the people's history. We're going to wrap this. So in terms of shares versus property, and I understand with your two hats that it feels a little bit fence sitting, right? Because naturally it's difficult. You can't actually, your job is not to steer people one way or the other. It's to look at a bunch of factors, their history, their risk appetite. You need to educate them, because obviously the less education they have on an asset class, that's not a good outcome for the client, for them to not understand what they're doing. That's part of your job. Understanding data, and of course you refer to the fact that big data houses can manipulate things, and that will confuse even professionals, let alone people that aren't in those industries. And then factoring in how people buy certain assets will also impact that property versus shares. So do you have anything to add to that?
Yeah, look, what I will say is that the other thing is time. All right. So if somebody's got a time horizon of, say, 3, 4, or 5 years, that can impact the decision as well. So because I don't know what your experience is, Dave, but my experience is generally with property, you've really got to commit to it for call it a 7 to 10 year time frame. And so if somebody says I've got this goal in 5 years, right? So it's harder for me to have a conversation around property. All right. So, but what I would say is that even though it feels like fence sitting, the real call it benefit is that if you sit down with the right person and have a conversation for no more than an hour, I can almost guarantee that most people will walk out knowing whether they want to go down the path of property or shares. And I think that's the key thing, is that it's really having a conversation about all of these ingredients to then determine what the first step is. And
Yep.
I would say that, a good, healthy portfolio has both. But yeah, that's probably the conclusion I can make at the moment.
All right, but
maybe we need a part 2 to this conversation.
But come on, just give us even if the vote is 51-49, where's it leaning? Do you have a lean?
Look, I think a lot of people. I think a lot of people have been frightened by the stock market over the last 2 or 3 years. It's had a bit of a comeback of late, all right? And so, but in essence, you get that volatility. It's been extremely volatile in the stock market for the last 2 or 3 years, ever since the beginning of COVID. And then you also get, all of these stories that are coming out around, lack of supply with property, tenants, having to pay extra rent and things like that. Look, it is hard to, to come out and say that one's better than the other, but I think a lot of people would find it hard to, to go against property at the moment, as long as they've got the right ingredients in place. They understand what they're doing and all the rest of it.
Great. That's an awesome wrap. Anything to add to that?
No, all good. All I'm going to do is say that there will be a disclaimer at the bottom of this video, just to help everyone make sure that this isn't personalised advice, and they need to come and see me if they want to dig into the weeds, as we might say.